Good evening, students. Welcome to the session. I hope you have revised the classes because there has been a good gap between the classes. I hope you have revised it. Yes. So I'll not go into the poem and all sections because that we have already recapped in the last class. What I will try to do is I'll just quickly recap what we did in the last class and then we'll take it ahead from there because this is going to be our last lecture and we are going to even start today the GAAR chapter. Yes, good evening, Sardis. Good evening, Viraj. Good evening, Dev. So yes, we'll just quickly recap. Yes, good evening, Mansha. Viraj, yes, you have to read the modules so that you get the hang of the exact topic because of course the lectures would help you out. But then you have to rely on the modules also in entirety because that is something which is going to be the base of your studies. Of course, the lecture is just for the explanation purpose, but then you have to read modules for all the subjects, not only for direct tax. Yes, good evening, Mansha. Good evening, Shankara. Uh, Thank you so much, Shankara. I'm glad to know that the lectures helped you. Thank you so much. And yes, all the best for your exams as well. Okay, so just let's quickly revise basically what we have done in the last class. So last class, if you remember, we had done the section 9 after section 911. We had done the section 912. We had done the capital gain computation. So all of that, we had done that, isn't it? And then if you remember in the capital gain computation, we had specifically seen the capital gain taxation for the NR, which is the first proviso to 48, which allows for the foreign exchange fluctuation benefit. And secondly, in the foreign exchange fluctuation benefit, it is allowed only to a non-resident who purchase the shares of the Indian company or debentures of the Indian company. And in that particular case, you get the foreign exchange fluctuation benefit. So you convert your purchase cost, your sales consideration, expenses on transfer into the forex, and then you reconvert and you can calculate the capital gain, and then you reconvert that capital gain using the TTBR rate as on the date of transfer again to find out the capital gain in INR. So basically you get the foreign exchange fluctuation benefit. Foreign exchange fluctuation benefit, that's the first proviso to 48, is not available in case if you opt for 112A or 112, the taxation on the unlisted shares. Okay, so 112A, 112 does not allow you that. If the 112A listed equity shares on which STT is paid, secondly, the unlisted shares under 112, both do not allow the claim of the first proviso to 48 or the second proviso to 48, both, right? And then we had seen the taxation of the NRI, the capital gain taxation of the NRI, non-resident Indian, who is basically Indian citizen or a PIO, whose either of parents or grandparents were born in undivided India. That is chapter 12A. Again, there if you purchase the shares of Indian company, debentures of Indian company, deposits of Indian public limited company or the central government securities in foreign exchange, then on the investment income, 20%. On the LTCG, it is going to be 10%. Plus, you will get the benefit of first proviso to 48. So, first proviso to 48 is not restricted under chapter 12A. Although you do not get any deduction under chapter 6A, no indexation benefit, but you can claim the first proviso to 48 if you are NRI and opting for chapter 12A. Further, there is an exemption under 115F on reinvestment. So if you reinvest the amount of capital gain into the new asset, so LTCG into amount invested divided by net sale consideration, the lock-in is for, of course, 3 years period, and the exemption granted earlier, if you sell the asset within that lock-in period of 3 years, then the exemption granted earlier shall be taxed as LTCG of the previous year in which new asset is transferred. Okay, then ROI exemption is there. If you have the LTCG income and investment income and TDS is deducted, then you may choose not to file the ROI. Then we had seen, of course, the ADRs and GDRs, if you remember. So ADRs and GDR, the taxation of that also we had seen, which is under 115AC, right? So LTCG, if the GDR are transferred from one non-resident to another non-resident, LTCG or STCG, the capital gain is exempt under 47. If the GDRs are transferred by non-resident to a resident, then under 115 AC, 10%. STCG will be taxed at normal rates. Are we clear? Dividend again at the rate of 10%. Here you will not get the indexation first proviso to 48 chapter 60 deduction. You will not have. And the TDS is under 196C. Of course, there is here also the exemption from filing the ITR. If you have only this income and TDS is deducted. Next is the 115AD FPI. For that again, for the FPI, you have the LTCG taxable at 10% on the listed shares referred under 1128 at so 10% over 1 lakh. On the other securities other than 1128 is again 10%. STCG on the listed securities under 111A 15%, on other it is 30%. Interest under 194 LD, which is on the rupee denominated bond, 5%. Any other interest, it is 20%. Here, this is again on gross basis, no chapter 60 deduction, no benefit of first proviso, no benefit of indexation. Then the surcharge, which is there, is capped to 15%. Even if the total income exceeds rupees 2 crore, if the income includes dividend, LTCG or STCG as referred to in on the securities referred to in 115AD, meaning all the listed, unlisted securities. So LTCG, STCG, dividend, the maximum surcharge will be 15%. And in case of AOP, if the income is under 115AD and if AOP only has company as members, then the maximum surcharge also will be 15%, even if total income exceeds 1 crore. TDS is under 196D. TDS is under 196D on income other than capital gain, 20%, and in case of rupee denominated bonds under 194 LD. Then we had seen 912 salaries deemed to accrue or arise in India. If the salaries are payable by government, then to Indian citizen or for services rendered outside India. Salary payable by the government to Indian citizen for the services rendered outside India shall be deemed to accrue or arise in India. Of course, the allowances and perquisites which are paid outside India are exempt under 10(7). Salaries, if it is payable to a non-resident, if it is earned in India, when it will be regarded as earned in India, when the services are rendered in India. So the salaries which are payable for the services rendered in India, then in that particular case, it will be deemed to accrue or arise in India for a non-resident, right? And then we saw that there is a short stay exemption which is available, which is remuneration received by a foreign national as an employee of foreign company. If the foreign company is not engaged in a business or trade in India, stay of employee is less than equal to 90 days. Income of employer in India is not after claiming deduction of the salary, then the remuneration received is going to be exempt under 10(6). Further, remuneration to individual who is not an Indian citizen receiving from embassy of foreign state, again that is exempt under 10(6). Okay. So these were the broad salary contours that we studied. Then TDS is under 192. If the salary is payable in foreign exchange, then you use the rule 115 for the purpose of conversion. Good evening, Munish. Yes. Okay. So then this was about the salary. Then we saw the 914, which is dividend. So dividend payable by a company outside India, Indian company outside India, that will be deemed to accrue or arise in India. Tax is under 115A, 20%. If received from unit at IFSC, then 10%. If the dividend income is received from business trust, if SPV is exercising the option to pay tax as per 115BAA, then 10%. If the SPV is not exercising, then dividend is exempt. This is also what we have done. Then interest, we have seen interest. If it is interest, royalty and FTS, the source rule remains the same for all three of them. What was the source rule, student, for all three of them? Yes, because now we are going to start with the FTS. And yes, what was the source rule, students, quickly, for the dividend, for the interest, royalty and FTS? Yes, faster. When can the interest, royalty and FTS be set to deemed to accrue or arise in India? Yes. I need the answer, students. Yes, students, faster. Dependent on payer of service. Yes, Shankara, you are right. Yes, Namrata, correct. So, if the payer is resident, if the payer is government, it shall be deemed to accrue or arise in India. If the payer is resident, it shall be deemed to accrue or arise in India. Exception is there if it is in regard to the business carried on outside India or for making or earning any source of income outside India. In that case, it shall not be deemed to accrue or arise in India. In case a payer is a non-resident, then it shall be deemed to accrue or arise in India if it is for the purpose of business or profession carried out by the non-resident in India. Then we had seen what is the meaning of interest under 228 is defined, right? Then we had seen that the payment by the branch, if the branch, payment by the branch to the HO, if the HO is engaged in the business of banking, then the payment by the branch, the interest payment by the branch to the HO shall be deemed to accrue or arise in India, and the branch will be allowed as a deduction of the interest expense subject to the condition that it has deducted the TDS, and for the HO, the interest income will be deemed to accrue or arise in India, and the income shall be taxable in India for the HO. So the deduction will be allowed to the branch while computing the income of the branch. The branch shall be treated as separate and independent from the HO. It shall be deemed that the branch is separate and independent from the HO, and the income shall be taxable in the hands of the HO. Are we clear? Then how is the interest income tax? Interest on the rupee denominated bonds for the FPI under 5 at the rate of 5% under 194 LD. Interest under interest on the rupee denominated bond and on forex loan at the rate of 5% under 194 LC. Then interest on the IFSC units, interest paid by the units in the IFSC on rupee denominated bond 9% under 194 LC. Infrastructure bond again 5%, others it is 20%. And interest on NRE accounts, it is exempt. Then we had seen the meaning of the royalty, transfer of all or any rights in respect of patent, invention, model, design, copyright, literary, artistic or scientific work, or use of patents or use of commercial, industrial, scientific equipment, imparting of any information concerning the working of patents or any information concerning technical, industrial, commercial or scientific knowledge. So that was the meaning of royalty, right? Now we are seeing the meaning of the FTS, and then we'll see the taxability of royalty and FTS, student. Okay. Yes, Namrata, you are correct. Okay. So let's proceed further. Now, what is the meaning of FTS? We had seen the meaning of royalty. Now, what is the meaning of FTS? And sorry, before we go into FTS, we have one more point left in the royalty aspect. Now, under the royalty, student, there were few amendments made in the definition of the royalty. There were few amendments made in the definition of the royalty. We'll just quickly see what are those amendments. So this much is clear, the meaning of the royalty. Is there any question till now? Yes. Any question till now till the meaning of the royalties is concerned? Yes or no? No question, right? Now, what are the amendments which are made in the definition of royalty, which is what we have to see first. And then we'll, of course, move on to the definition of FTS. So, the Income Tax Act had made several amendments, which were even the retrospective amendments to the definition of royalty. We'll understand the reason for that also. Now, if you see, the royalty means consideration, which is for the transfer of all or any rights, including the granting of license, which is for the patent, invention, model, design, secret, formula or process. There were several doubts that whether the transfer of computer software or the purchase of computer software does it give rise to the payment of royalty? Like the payment for the purchase of computer software, does it constitute the royalty? So students, you purchase the computer software day in and day out. We are using so many computer software. You are using Tally ERP9. You are using many other softwares for the calculation of TDS, for the filing of TDS return, for filing of income tax returns, isn't it? Now, the payment that you make, is it royalty? That's the question that we have to answer. Now, you will say, ma'am, how the purchase of software constitutes royalty, under which clause it falls into. So, student, the department was trying to fit in to say that transfer of all or any rights in respect of the copyright. So what they were trying to say is that if the computer software is given, now computer software results in the transfer of the rights in the copyright. Ma'am, we are not clear. Let me explain. Student, you know that there is a copyright law, right? There is a copyright law which is existing, isn't it? Now, if you see this copyright law, under the copyright law, the computer software is included. The computer software is protected by the copyright law. Good evening, Dave. So, what the income tax department's contention is that this computer software, since it's protected by the copyright law, so when I purchase any computer software, student, at that point in time, the copyright is transferred. Some right in the copyright is transferred. And therefore, that constitutes the royalty. The courts across the country have given the different opinion. For example, Delhi High Court said, no, this doesn't constitute royalty. Purchase of computer software does not constitute royalty. Delhi High Court's view was that there is difference between copyright and the copyrighted articles. There's a difference between copyright and the copyrighted article. When I say I have purchased the software as an end user, I have paid for the purchase of the copyrighted article and not for the purchase of copyright. Are we getting that distinction? So that distinction is very, very important, students. So the Delhi High Court held in the favor of the taxpayer. Whereas if you see the Karnataka High Court said, no, the purchase of computer software indeed results in the transfer of the copyright. Now, what is the correct view? The matter reached to Supreme Court. So students, here and after, whenever you download any computer software, you will notice now that there is something called as end user license agreement that you agree to. Terms and conditions which are given. There is something called as end user license agreement, which you sign with all the companies whose computer software you download. Any computer software, whether you buy it online, there are certain computer software now which are available online. You don't even need to download that, and you just need to buy the subscription of that. So any computer software that you buy, you will see that you sign the end user license agreement. Now, this agreement is very, very, very important, students. This is very important. Now, I'll tell you why is it very important. Because this will give you the idea as to what rights are transferred to the user. What rights are transferred to the user. So this is very, very important to see. Now, why I'm saying this, what rights are transferred to the user, students? Because when I say that I get the copyright, when I say I get the copyright, that means I have the rights which the owner has. See, this you will understand only when you go into the copyright law. Because see, we are referring to copyright and therefore I will have to refer to the copyright law because copyright is not defined in Income Tax Act. That is defined under the copyright law. So when I go into my copyright law, I will see that what kind of rights, if we give it to the user, will result in the transfer of copyright. So basically, what is copyright law, students? Copyright law is protecting the owner who has developed some software, who has developed certain work from getting it copied. So the infringement is protected. If I obtain a copyright, if I copyright my software, if I copyright any work that I have done, any literary work, that is protected by the copyright law. If I obtain the copyright, just like, you do have the trademarks, you do have the patents. Similar is the copyright, meaning this is my property. Now, if I part away the rights that I have as an owner, if you can do what I can do, I'm the owner of copyright, I'm the owner of software. If I'm parting away certain rights, student, to you, to do what I can do, what I can only do, because I have the copyright. This is my exclusive right. If I'm giving you even one right, what I have, then yes, I have transferred the copyright. So the department's contention has been, students, that the owner transfers the right to download the software. The owner transfers the right to back up the copies of the software. So, there are multi-user licenses. Even in Tally, you will see there are multi-user licenses. You can download on multiple PCs. So, the revenue is saying that, look, this results in the transfer of copyright. Because you can download it on multiple PCs. You can back up for your purpose, for your safety, for your recovery purpose. That means you have the copyright transferred. One right is transferred. Delhi High Court said, no, this is a limited right which is transferred. You are not allowed to break the code of the software. You are not allowed to make the changes in the software. If you are allowed that, yes, then you have the copyright. If there are restrictions on your usage and you are transferred a limited right for the purpose of using that software, that is not transfer of copyright. So, because of these contradictory decisions, the Parliament amended the Income Tax Act. And what they said is, they said that the transfer of all or any rights in respect of any right, property, or information includes and has always included, meaning it's a retrospective amendment. Includes and has always included transfer of right to use computer software. including the granting of any license, irrespective of the medium through which such right is transferred. So students, if you now see that the definition of royalty now includes the transfer of computer software specifically. Namrata, I'll explain the distinction. Do not worry. So basically, if you now see that the computer software is included specifically within the definition of royalty. What the Delhi High Court was saying is that there is difference between the copyright versus the copyrighted article. What you get, what you buy as a software is a product. It's a copyrighted product and not the transfer of copyright. When I say there's transfer of copyright, meaning I have the rights what the owner has, meaning I can change the coding of the software. I can reuse and implement it in another software. That is the copyright. Whereas what I'm getting is a product. That is a copyrighted article. Link it with an example of book. When you purchase the book, even book is a literary work, right? When you purchase a book, does the writer, does the author gives you the copyright in the book? Answer is no. What you purchase is the copyrighted product, copyrighted article. You cannot reproduce the book, right? If you can reproduce the book, if you can make a new copies of the book, then you have the copyright. Same is with the software. Yes, Mansha, it means kind of a read only. Isn't it? So what you get is only a limited right. And therefore, this retrospective amendment was made in the income tax law. Are we clear? To say that the transfer of copyright, transfer of purchase of computer software results in the transfer of the copyright. Is this clear? Any questions? Yes or no? Any doubt, any question? Is this clear? So this is the amendment in the definition of the royalty, which has been made in 2012, but retrospectively. Now the matter reached to Supreme Court. The matter went to the Supreme Court. What did the Supreme Court say? Now, before the Supreme Court, the question was whether the amount paid by the end users or the distributors, so one who purchase and resell without making any modification. So, amount paid by end users or the distributors to the non-resident computer software manufacturers or the suppliers, whether this is royalty. Whether this is royalty. This particular case was dealt by Supreme Court in engineering analysis case. So the apex court observed that the definition which is given in section 916 provides that the royalty means consideration for the transfer of all or any rights in respect of any copyright. And now a new explanation has been introduced to say that the transfer of right to use a computer software also is included in the definition of royalty. So yes, under the Act, the statute has already expanded the meaning of royalty to include the purchase of computer software. However, when we are going to read the DTAA. So remember I told you that you have to look not only at the provisions of the Act, because first you will have to look into the Act, whether you have the taxing right under the Act or not, whether the income tax authorities have the taxing right under the Act or not. You will look into section 9 for a non-resident. And then you will look into the DTAA. If we read the DTAA, there also the royalty is defined. There also the royalties are defined. Now in the DTAA, the definition of royalty does not include the right to use a computer software. So the income tax department's contention was that if the definition of the royalty under DTAA does not include the computer software, we can import the definition of royalty in the Act to the definition in the DTAA. This was the approach of the income tax authority. Supreme Court said it cannot be done like that. The definition under DTAA does not include, so you cannot include the definition of Act into the DTAA. Because when the DTAA was signed between two contracting states, they had agreed for such a definition. If they wanted to include computer software, they would have specifically included for that. This is not there. So therefore, in this case, you cannot read the definition of the Act into the DTAA, and under the DTAA, this will not be treated as the royalties. Even though under the Act, you have included it specifically now. But at least under the DTAA, this is not included. So the provisions of the Act or the provisions of the treaty, whichever are beneficial, will be applicable. So here, Supreme Court held that purchase of computer software. Purchase of computer software does not result in transfer of right in the or right to use the copyrights. So Supreme Court agreed that the purchase of the computer software is a copyrighted article purchase. It is not a transfer of right to use the copyright. Supreme Court agreed with the assessee's contention that when I purchase a computer software, I do not get any right to use the copyright. I have only a limited right to download, to use the software, and that does not result in right to use the copyright. It is merely a copyrighted article which I am purchasing. Held that purchase of computer software does not result in transfer of right to use the copyright. And therefore, does not constitute as royalties under the DTL. Under that, they have amended. But under the DTAA, it is not amended. So the provisions of the DTAA being more beneficial than the provisions of the Act shall apply. Provisions of the DTAA being more beneficial than the provisions of the Act shall apply. So what were the 4 cases in which the Supreme Court considered this particular aspect? Supreme Court held that in following 4 cases. First is purchase of computer software by the end user. Purchase of computer software by the resellers. Then software embedded into hardware. In following 3 cases, that's right. Okay. So basically, if you see, students, what was held by the Supreme Court was that even though the Income Tax Act is amended, but you cannot treat the definition of royalty in the Act to the definition of royalty in the DTAA. Under the DTAA, the royalty definition is not including the transfer of the computer software. And the purchase of the computer software by the end user or by the reseller who is not making any changes does not result in the transfer of the copyright, because what is transferred is the product, the final product, which is the computer software. Only limited right to use is given. He cannot change or alter the code of the software. So that means the copyright is not transferred. Yes, Namrata, even the ICAI module is copyrighted books. So when you, let's say, pay, for example, pay for your module, you do not get copyright. Isn't it? Software embedded into hardware means, Namrata, let's say, for example, I buy an equipment in which the software is inbuilt. Again, there is no copyright which is given to the user who is purchasing the hardware containing the software. Namrata, why not transfer of computer software is not copyrighted article? It is copyrighted article, Namrata. Supreme Court also accepted it. It's not what you're saying. It's copyrighted article. Yes, students, any questions, any doubt? Okay. Any doubt, any questions? Yes or no? Is this particular point clear? Students, faster, yes or no? Okay. Now, one important thing other than this in the context of the computer software. So, there is also a CBDT notification which is issued. This notification says that certain software payments, payment for the purchase of software, TDS is not required under 194J because the act is amended, right? In the act, transfer of the computer software is resulting in the royalty. If it results in the royalty under the act, if it is paid by the resident to another resident, then TDS will be under 194J, isn't it, students? So if my TDS is under 194J, therefore the notification is issued that no TDS will be under 194J in following scenario. What's the scenario? This is non-resident or the resident, manufacturer or supplier. He supplies the computer software to the reseller. And this will further resell to the, let's say, end user or the another reseller. So what the CBDT notification says is, if the software is acquired by this end user or reseller, right, and no modification has been made to the software, it is just resold without any modification. And on this leg, the TDS is already deducted either under 195 or under 194J. Then here, the CBDT notification says, again, there is no requirement of TDS under section 194J. If the reseller, or you can just write, if the declaration is obtained that TDS is deducted in the earlier leg. If the TDS has been deducted in the earlier leg and PAN of transferor is obtained. If the PAN of transferor is obtained. So to avoid the TDS being deducted at every stage, the CBDT has issued this notification. Here, manufacturer can be non-resident or resident both. Tally software embedded into hardware? No. Tally software, how is it embedded into hardware? Hardware meaning some equipment. Let's say, for example, there are equipments, Namrata, which contain certain software, which will monitor, let's say, your heart rate. Maybe it monitors some machinery. It monitors something else. So that equipment which is containing the software. B2B transactions will not cover. Yes, that's correct, Mansha. Or even B2C also. So here it is B2C also, end user, as well as the reseller. So if there is no modification made by the reseller here, then CBDT notification says that the TDS under 194J is again not required if in the first leg of transaction the TDS has already been deducted. Namrata, it just says that in the first leg of the transaction, if the TDS is deducted either under 195 or under 194J, if the resident manufacturer is there, then the TDS will be under 194J. If the non-resident manufacturer is there, then the TDS will be under 195. So if in the first leg TDS is deducted and now it is being resold, this computer software is resold without modification, then in that case, the CBDT notification says no TDS is again required in this leg. If you obtain the declaration that the TDS in the first leg has already been deducted and the PAN is given. Is that clear? Is the distinction between the computer software royalty is clear? Yes. Engineering analysis decision. Is that clear, students? Please tell me. Yes or no, students? Shall I proceed further? Got it, Namrata? Very good. All of you? Give me the answers. Have you got this particular point that the computer software purchase does not result in the transfer of rights in the or right to use the copyright? Despite that, the act has been retrospectively amended to say that purchase of computer software will result in royalty, even though it does not result into that. But as I said, it is deemed provision. So something which is not there will be there if the act deems that, isn't it? Fine. Okay. Any questions, any doubt other than that? Is that clear? Okay. Fine. Now, one more thing which we have to discuss here is in respect of now the FTS. Now, what is the meaning of FTS? Now, under the FTS, the meaning of FTS. So, what is the meaning of FTS? FTS means managerial technical or the consultancy services. It does not include consideration for any construction, assembly, or mining project plus income chargeable as salaries. So A and B. Consideration for construction, assembly, mining project is not FTS. Secondly, it does not include the salaries. So what is the meaning of managerial, technical, or consultancy services? Managerial, technical, and consultancy services are not defined, students. Are not at all defined. So if it is not defined, what do we mean by that? We understand in the general parlance. Managerial means, students, what? Something which is services for the managerial role, managing the organization, managing the affairs of the company. What are consultancy services? Professional services. That is basically the consultancy. What is technical? The term technical is not defined. But the Supreme Court in Bharti Airtel case held that the term technical means that there has to be some human intervention. Entirely automated services cannot be considered as technical services. Now, what do we understand by that, students? So basically, in the Bharti Airtel case, the services which are provided for the purpose of the telecom, right? So in that particular case, the issue before the Supreme Court was that whether this results in the FTS. Basically, if you see the usage charges, the interconnection usage charges which are paid. What are interconnection usage charges, students? So these are the basically charges which are These are the basically charges which are paid to the telecom company, which is to arrange that call, right? So for the call charges, you pay that interconnection usage charges to connect the call, which is charged by the telecom operators for connecting to the network. So the revenue was saying that this is basically the technical service and should be classified as FTS. The Supreme Court said this is not FTS because here in these services, these are automated services. These are not requiring any human intervention. To understand what is the meaning of technical, we have to understand from the neighboring words. This is called as principle of aegyptium de generis. You have to understand the neighboring words meaning to understand the word technical. The word technical derives its color from its neighboring word, principle of aegyptium de generis. So managerial and consultancy requires human intervention to provide services. Technical also requires some amount of human intervention. Entirely automated services cannot be considered as the technical services. Even general services which are provided to everybody, that is also not technical. There has to be some customized service to you to call it as a technical service. So Supreme Court in Kotak Securities had held that general services cannot be considered as technical service. There has to be customized services. Now, students, tell me one thing. In Kotak Securities case, what happened? In Kotak Security, the Kotak Security was basically availing the services through the stock market. Right? So the stock market provides the standard services to all the brokers. They charge that certain fees, right? For providing the services to all the brokers for listing. So basically, that is not a technical service. Because it's a general service provided to everybody. It's a general service provided to everybody, right? So that cannot be called as the technical service. It has to be some amount of the customized service. It has to be some exclusive service to be called as technical. So that's the meaning of the term technical. Are we clear, students? Yes or no? Any question? If there is a conflict between the Act and the Supreme Court decision, who will prevail? So see, Namrata, if the Supreme Court decision is given to explain the Act, so the Supreme Court decisions become the law of the land. But if the Act is amended after the Supreme Court decision is given, like for example, it happened in Vodafone case. The Vodafone decision came by Supreme Court, and then to override that decision, the Supreme Court override the Supreme Court decision, the Act was retrospectively amended. Then obviously the Act will prevail. If the Act overrides the Supreme Court decision by retrospective amendment or by any amendment which is made, then of course the Act will prevail. Is this clear, students? Yes or no? Now, there is one important last point in relation to the FTS. So, students, see, what happens is there are the consolidated contracts which are signed by the non-resident. So, let's say, for example, there's one non-resident company which is into the manufacturing of machineries. Okay. Now there is this Indian company who wants to import this machinery. So let's say, for example, if this is paying the fee, but the contract is for the contract that is signed by the Indian company with the non-resident company is one is for supply of designs. Supply of designs. Second, supply of machinery. So first they will supply the design. According to the design, if it is finalized, then the machinery will be supplied. Then finally the installation of the machinery. Now this is regarded as offshore supply of services. Offshore, provided outside India, because these designs will be provided outside India. Supply of machinery. This is also offshore supply of goods. And the machinery, the technicians will come to the place of Indian company to install the machinery. This is onshore supply of services. So offshore supply of services, offshore supply of goods, and onshore supply of service. Now this is payable by the Indian company. So the payer is the Indian company. So in that particular case, FTS shall be deemed to accrue or arise in India. Now, installation services are FTS, right? These are technical services. So this will be deemed to accrue or arise in India. This is not for the business of the Indian company outside India. So therefore, in that case, there is no question of getting into the exclusion. Isn't it? This is fine. What about the offshore supply of goods? This is my business income. Isn't it? Now, business income, for it to be taxable, business income of a non-resident can only be taxed in the source state if there is business connection. If there is business connection. Let's say, for example, this non-resident company is just supplying to this Indian company one of a time. It's just an isolated transaction. It's not something which is a routine transaction. So for a business connection to be constituted, there has to be a regular doing of business in India. An isolated transaction cannot result in the business connection. So if there is business connection or P, let's say, for example, we say there is no business connection or no P. Since isolated transaction is done. So this income shall not be deemed to accrue or arise in India. Now, what about this services? So in this case, this particular question was before the Supreme Court. In the case of Ishika Wajima Harima. This is a Japanese company and hence the name like this. The Supreme Court said this shall not be taxable in India. Because for the services to be taxable in India, the services should be utilized in India, plus they should be rendered in India. In this case, the services are utilized in India, but the services are not rendered in India. So these services are utilized in India by the Indian company, the design, but these are not rendered in India, because these are rendered outside India, isn't it? So the Supreme Court said these services will not be taxable in India. As I said, the Income Tax Department was not happy with this decision. So they made a retrospective amendment. What is the amendment? What is the retrospective amendment? They say that the FTS shall be deemed to accrue or arise in India and shall be included in the total income of the non-resident, whether or not the services have been rendered in India. So, retrospective amendment was made under the Act to say that FTS shall be deemed to accrue or arise in India, whether or not services are rendered in India. So, irrespective of the services are not rendered in India, still it will be deemed to accrue or arise in India. So, by this retrospective amendment, these shall be taxable. So, even if the services are provided or rendered outside India, the Act now says it will still be taxable in India. Is this particular point clear to all of you? Yes or no? So let's say, for example, in this particular case, even if the services are rendered outside India, these supply of designs were rendered outside India, but still now these will be taxable in India. Because of the retrospective amendment, the Supreme Court decision has been overridden. Yes, students, is this clear? Any questions, any doubt? Yes or no? Any doubt, any question, student? Yes. I am waiting for your answers. Ishika Wajima Harima. Namrata. The case name was the Ishika Wajima Harima. Fine. Is this clear? Okay. Now, how is the taxability of FTS and royalty going to be under the Act? So just write down. Here, it is not like interest or dividend. You need to see if there is PE and if there is no PE. So if there is PE, the taxability will be on net basis under section 44D, and then the tax rate shall be 40%. And if there is no P, then there will be taxability on the gross basis under section 115A, meaning no deduction of any expenditure. That shall be at the rate of 20% plus surcharge plus cess. Are we clear? So if there is PE in India, then the taxability shall be on the net basis. If there is no PE in India, then in that particular case, the taxability shall be on the gross basis under 115A. Also, students, under 115A, with respect to interest, dividend, royalties, FTS, all of the income that you see are going to be taxed under 115A. Now, if you go under 115A and your total income includes either dividend, interest, royalty, FTS, and the TDS has been deducted at that particular rate in the 115A, you are not claiming the DTAA benefit, then you are not required to file the return of income. So, exemption from filing the ROI if TDS deducted at rate under section 115A and only income is dividend, interest, royalties or FTS. If you claim the treaty benefit, then of course, if you're going for a rate lower than 20%, then you are required to file the ROI. Net basis, Mansha, means after claiming the expenditure. Gross basis means without claiming any expenditure. Okay. So here you will not get any deduction of any expenditure. It shall be on the gross basis. Net basis meaning you will have to claim the expenditure, all the expenses which are in relation to the P that you can claim. But at the same time, you will have to get your books audited and you will have to maintain the books of accounts also. Are we clear? So that is the provision under 44DA. That is the provision which is given under 44DA. Okay. Any questions? Yes, I'm going to explain the 44DA for sure. We are just starting with that. But this is what is the summary. Now, what does 44DA provides? 44DA provides how to compute the royalty or FTS, income from royalty or FTS. So, in that particular case, this will be on the net basis. Net basis is basically your gross receipts minus the expenditure is equal to your profit. Now, what expenses are not allowed to be deducted? What expenses are not allowed as deduction? Expenditure not wholly and exclusively for the PE. So expenditure which are not only for the PE. Secondly, amount paid by PE to the HO. Other than reimbursement of expense. So if it's a reimbursement of expense which is borne by the HO and PE is reimbursing those expenses to the HO, then that is fine. But any other amount paid by the PE to the HO will not be allowed as deduction. Because what the PE will try to do, PE will try to lower its profit by making some expenses to the HO, admin expense, office expense, whatever. That is not allowed. Yes, if let's say, for example, HO has paid to certain employees of PE and PE is reimbursing for that. So actual expenses, if they are reimbursed, then in that case, there's no problem. Plus mandatory maintenance plus the audit of books of accounts. Mandatory maintenance plus the audit of the books of accounts. Clear? Any questions? Any doubts, students? Yes, is this clear? So in the case of the FTS and royalties, both students, this shall be on the net basis if there is a permanent establishment. If there is no PE students, then in that particular case, there will be on the gross basis. So it is 44 DA versus the 115B. Okay? Yes or no? Fine. Will you solve one question on this? Let me put you a question so that you have the idea about 44 DA. Let me give you a question. I think there was some issue. 1 second. Okay. So ABC Incorporation has business operations in India. It has started an office in India. The ABC INC has entered into a contract with RIL to provide the designing services in respect of new project to be started in Gujarat. ABC INC will be providing these services through its local office in India. For this purpose, it has hired 10 employees whose salaries are 1 lakh each. Salaries will be paid by ABC INC and will be reimbursed by the local office. The office expenses during the year are 2 lakh. ABC INC has also purchased the designing software amounting to 2 lakh. ABC INC will charge 50,000 to the local office for the same. However, the software will also be used by the other office. ABC INC has also charged some common admin expenses to the local office amounting to 1.5 lakh. The designing charges received during the year were rupees 20 lakh. So in this case, what will you do, students? Yes. Quickly tell me. Namrata, you will understand on this particular question itself. What will be the answer in this? Yes, students, faster. What shall be your answer, students? Okay, let me explain here. So first of all, here it is FTS. Yes or no, students? These charges, designing charges will be FTS. This will be FTS. Yes. Now, once I say it is FTS, there is a PE in India through the local office. So this shall be taxable on net basis under section 44D. Isn't it? Now, what is my income? 20 lakh. So gross receipts are 20 lakh minus the expenses which are allowable. So first they are saying that the salaries paid by the ABCN would be reimbursed by the local office. So this is the actual expense paid by the HO. Branch is reimbursing that. So then in that particular case, 1 lakh is the salary. There were 10 employees. So then in that particular case, 10 lakh. Fine. Then salaries will be paid and will be reimbursed. Office expenses during the year amounted to 2 lakh. So that will be allowed. Fine. ABC has also purchased the designing software amounting to 2 lakh. ABC INC will charge 50,000 to the local office. Now, will this particularly be allowed? Answer is no, because this software is also going to be used by other office. So this is not wholly and exclusively for the PE. So that shall not be allowed. Even the admin expenses will not be allowed because these are not the actual expenses. These are just charged or cross-charged expenses. So in this particular case, this will also not be allowed. So admin and software expenses not allowed as not wholly and exclusively for the P. As not wholly and exclusively for the P. There's some problem here. Yeah. I think there was some issue. Office expenses, 2 lakh. So admin and software expenses will not be allowed as not wholly and exclusively for the PE streams. So this year, net profit will be my 8 lakhs. This shall be taxed at the rate of 40%. Are we clear, students? Yes, Mansha, you are right. Okay? Fine. Is this clear? Right? Yes or no, students? Any questions, any doubt till now? So this is about the royalties and FTS taxability. If you have any questions, you can ask me. Yes or no? Fine. Okay. Now, students, we will get into the double tax relief chapter. Now we'll go to the double tax relief chapter. Now, what is the double tax relief obligation that we have to see? So students, understand this particular point. See, till now, what you were talking about is for the non-resident. So what I was trying to identify is, student, that if a non-resident has the income accruing or arising in India at the first place. So to identify that, we look into section 5 and section 9 because section 5 says only the income accruing or arising deemed to accrue or received in India is taxable for non-resident. So when can I say that the income of the non-resident is deemed to accrue or arise or accruing or arising in India? I need to look into section 5 to identify whether it is accruing, or I need to look into section 9 to identify whether it is deemed to accrue or arise in India. For a resident, section 5 says worldwide income is taxable in India. worldwide income is taxable in India, isn't it? So if my worldwide income is taxable in India, students, then what will happen, students? I will have double taxation. First, the income will be taxed in the country where it is sourced, and then again India will be taxing it because I will tax the worldwide income of my resident. So for that purpose, we have the double tax relief obligation in place. So section 90 of the Income Tax Act talks about the double tax relief obligation. What is section 90 of the Act saying? We will have a look into it. So, double tax relief under section 90. What is section 90 is saying? Let's have a look. So section 90 of the Income Tax Act has multiple rules. I'll just show you what section 90 is talking about. We'll try to look into each of these. And then, of course, we'll see the sum as to how the double tax relief is given. So, let me copy the section 90 for you. Okay, students, let me just expand this to see what it is saying. Is it visible to you? So section 90 is saying the central government may enter into an agreement with the government of any country outside India. So this section 90 is empowering the central government to enter into the tax treaties. See, students, if you look into the Constitution of India, if you look into the Constitution of India, the Constitution of India is giving us the power, is giving the power to the executive to enter into the tax treaties or to enter into any international agreement. So, the Constitution of India gives the power to the Union Executive. Union Executive means the President, Prime Minister, basically the Parliament. So the Constitution of India gives the power to the Union Executive. Union Executive consists of President, Vice President, Prime Minister, and the Council of Ministers. So it's nothing but the power lies with the Parliament to enter into the tax treaty. So this power is with the Union Executives under the Constitution. Now the Constitution has given the power that yes, the executive can enter into any type of treaty. With regard to the international relations it has to maintain. Now this power, since it is with the Parliament, and Parliament cannot ratify each and every treaty, because see, the Act is already there. If you want to amend the Act, you have the Finance Act, right, students? So if you have the Finance Act, because of that amendment, you can make through only the Finance Act. The Act is already created by the Parliament. Now, if the power is with the executive, meaning each and every treaty will have to undergo the parliamentary procedure, students. So, Article 253 of the Constitution gives the Parliament to make the laws with regard to the treaty. But Parliament, by way of Income Tax Act, has delegated this power to the central government to enter into tax treaties. So it is a delegated power to the central government, students. Isn't it? So you can just write it over here. The power under the Constitution is with Parliament. So this is delegated to the central government. Why the treaties have to be entered into? For granting of relief for the income which is getting taxed in India as well as in the other country, for the purpose of avoiding the double tax. So basically, India as a source country will say, yes, I will restrict my right to tax. If under the act, I will tax royalty or FTS at 20%, under the treaty, based on the negotiation with the other treaty partner, based on the economic power of the other country, I will agree to reduce the rate of 20% to, let's say, 10%, to 15%, to 5%, to 0%. Under different DTLs, there are different rates. So I will agree to avoid the double tax by restricting my right to tax what I have under the Income Tax Act. But students, there is a new amendment over here. What they say is, without creating the opportunities for the double non-taxation or reduced taxation through tax avoidance or evasion, including through treaty shopping arrangements. Now, what does this mean? This means, students, that let's say, for example, if there is a company of US, this wants to invest in India. Now, let's say, for example, if it invests in India directly, there will be, let's say, when it exits from India, when it sells the shares of Indian company, the capital gains shall be taxable, let's say, at 20%. Capital gain, let's say, is taxable at 20%, because under the India-US DTAA, there is no benefit on the capital gain tax. So what it is trying to do is, it is trying to find out the favorable treaty with India so that it can come through that particular country. So let's say it comes up with Mauritius, because India and Mauritius have favorable treaty on, let's say, capital gain, or favorable treaty article on capital gain, wherein, let's say, for example, capital gains are not taxable in India. So it is setting up another special purpose vehicle, SPV, or intermediate company in Mauritius. And then Mauritius company will invest in India. So the only job of Mauritius company is to save taxes in India. And that is why this Mauritius company is incorporated. There is no other purpose of incorporating Mauritius company. There are no employees, no office, nothing. So this will result in zero taxes in India when let's say, for example, when US company wants to sell the shares, it will sell the shares of Mauritius company. Although it can result in indirect transfer, but we are talking about the treaty. Under the treaty, there is no capital gain tax, and therefore even the indirect transfer, if it is triggered also under the treaty, it will be prevented. Why? Because the provisions of the treaty are more beneficial. So this arrangement is known as treaty shopping. I told you last time also, right? The way you shop around different shops to find out the lower prices for a product, you shop around the treaties to find out the beneficial treaty. Now, what will happen is, let's say, for example, if there is no capital gain are not taxable in India, capital gain are also not taxable in Mauritius because Mauritius does not have income tax on the capital gain. So this results in double non-taxation. So what was happening prior to BEPS action plan? Most of the companies were engaging in these arrangements in treaty shopping in tax avoidance to result in double non-taxation. So now the act after the BEPS has been amended to say that even though the treaties are entered into for avoiding double tax, but the treaties will not be allowed to use if there are double non-taxation happening. If there is double non-taxation happening, we will not give the treaty benefit. So in this case, treaty benefit shall be denied. In this case, the treaty benefit shall be denied. Then what else is the purpose of entering into tax treaty? For exchange of information. So one country will share the information with another country with regard to its residents so that the residents are not able to evade the income, avoid the income by transferring it to another country. So, Panama paper leak, Lux paper leak, the information was passed on, right? Every day, the information is getting shared under FATCA, under the common reporting standards. The information is shared by one country to another country, whether your resident has a bank account, has immobile property, has any shares in the other country. For recovery of income tax, let's say, for example, if the person avoids income tax over here, does not pay income tax over here, and he runs away to another country, this government can request the another government to recover the income tax by attaching the property in that country. So these are the purposes of entering into tax treaty. Then section 90 subsection 2 says, where the central government has a treaty, has entered into treaty, then in that particular case, the provisions of the treaty or the provisions of the act, whichever are more beneficial to the assessee, shall apply. So act or treaty, whichever is beneficial, shall apply. Act or treaty, whichever is beneficial, shall apply. But section 90 subsection 2A says that the provisions of the chapter 10A, this is basically the GAAR students. So the GAAR will apply even if it is not beneficial to the assessee. So provisions of the GAAR, if you enter into any tax avoidance scheme, the GAAR will apply even if it is not beneficial as compared to the treaty. Then it says any term used but not defined in this act shall have the meaning as per the, if any term used in the act or in the DTAA is not defined, then they have the meaning assigned to it in the notification issued by central government. So if any term is not defined in the act or in the treaty, the central government can issue a notification to define that term. Are we clear? And then there are explanations which are introduced over here. If you see the explanation 3, it says any term, if it is used in the agreement and it is not defined in the agreement or in the act, then it shall be defined through a notification and the meaning shall be taken from the date on which the treaty has come into effect, not from the date when the notification is issued. Are we clear? And if any term is used under the agreement, if it is defined in the agreement, then you will take the meaning as in the DTAA. If it is not defined in the DTAA, if it is defined in the act, then you take the meaning in the act. If it is not defined in the act or in the DTAA, then the CG can issue a notification to define that term. Are we clear? Last point. An assessee who is not a resident of India, who is availing the treaty benefit, has to produce the TRC. So, in order to claim treaty benefit, a non-resident has to produce TRC plus Form 10F. Now, what is TRC and Form 10F? TRC is the residency tax residency certificate. And if it does not contains all the details, then Form 10F has to be submitted along with that to fulfill all the details which are required. Now, why this tax residency certificate is required, students? The tax residency certificate is required to show that you are the resident of the other country, because it should not happen that you are saying that you are resident of the other country, you are claiming the treaty benefit, and it comes out that you were just trying to fake that thing. So a TRC is issued by the tax authority of the other country, certifying that this person is a resident of our country. And if they say so, he is a resident of our country, then in that particular case, the treaty benefit only will be granted. So a treaty benefit to a non-resident, if he wants to claim a reduced tax rate or any benefit under the treaty, he can only do that by producing a TRC. If he doesn't produce TRC, the tax benefit will not be given. Or sorry, the treaty benefit will not be given. Are we clear? Yes or no? So we take a break over here for 10 minutes, then we get back and we get into the double tax relief. Okay, students, let's take a break of 10 minutes. Students, so now we are getting into the double tax relief obligation. Okay, so we have seen section 90. Section 90 is empowering us to empowering the central government to enter into tax treaty. The provisions of the act or treaty, whichever is beneficial, shall apply. GAAR will override the tax treaties. So basically you can write it over here. GAAR overrides the tax treaty. And in order to claim a treaty benefit, a non-resident has to produce TRC and Form 10F. Okay, and treaties are not to allow the double non-taxation. Jacob, no amendment in royalty and FTS. There is no such amendment. It's just that the tax rate is now 20%. Instead of the earlier, it used to be 10. Okay. Now, how the double tax relief has to be claimed for the residents. How the double tax relief has to be claimed for the residents. So basically, students, if you look at it, the double tax relief which are there, if a resident has income outside India, then the India will allow the relief of those taxes which are paid in the foreign country. So how the relief is granted? There is bilateral and then there is unilateral relief. Now, what are these two? This is to the resident. Double tax relief to the resident of India. So, if we have entered into tax treaty with the other country, then we have a bilateral relief. Bilateral relief means India will grant the double tax relief of the taxes paid in the other country to its resident. The other country will also grant relief of the taxes paid in India to their resident. Okay. So this is provided in section 90, read with the DTL. Mechanism is going to be the same in both. And this is the situation where no DTL exists. So let's say, for example, you have income from a country with which you do not have any DTL. For example, let's say Pakistan. There are many countries with Cyprus, with which, sorry, not Cyprus, the Panama. There are many countries with which we do not have DTL. Bermuda. So where no DTL exists, and if you earn the income from that country and it is taxed in the other country, then in that particular case, the unilateral relief is given in section 91. Meaning India by its own is extending the double tax relief. Now, how the double tax relief is given? There are two methods. Exemption method and the second one is the credit method. Under the exemption method, the income which is taxed in the other country is exempted in resident country. Whereas under the credit method, the credit of taxes paid in other country is allowed in a resident country. Now, all the developed countries use the exemption method. They exempt the income if it is taxed in the other country. But India follows the credit method. So here, whether it is bilateral or unilateral relief, the credit method is followed. So just like you get the credit of TDS, which has been deducted, if you pay the tax in the other country, then even that tax is allowed as the credit against the tax in India, tax payable in India. Are we getting that? Yes or no? Okay. So basically, India will allow you the credit of the taxes, whether it is unilateral relief or the bilateral relief. Yes or no? Unilateral relief means what? We do not have DTAA with the other country, but you have earned the income in that other country and the tax has been paid in that other country. Whereas bilateral relief means what? That there is a DTAA in between and both the countries have agreed bilaterally to provide the credit. Now the tax credit, how do we calculate the credit? So this is provided in Rule 128. This is dealt with in the Rule 128. This is provided in the Rule 128, both unilateral and bilateral. Okay. So how will the calculation will be? So it is basically lower of tax payable in India or the tax paid in foreign country. So lower of the tax payable in India on that income or the tax paid in the foreign country. Now you will have a question certainly, students. The question this will be that, ma'am, how do we calculate the tax which is paid in the foreign country? So that you will have, but that will be in foreign currency, students. That will be in the foreign currency, isn't it? Now, if the tax is in the foreign currency, how will you convert that tax? So that tax convert using the TTBR rate as on the last day of the month immediately preceding the month in which tax has been paid or deducted. Okay. So this is how the relief has to be given. This is how the relief has to be given. Now we'll solve a question on this to understand how the double tax relief obligation has to be given, so that you understand it in detail. Okay. Now how this double tax obligation relief is given, that we will understand it by way of solving the question, students. So let's write the question from your module itself. Let me just put up the question before you, so that you will have then the clarity. Give me a minute. I think it just takes certain time to copy that. It's not done. Let me just redo it. Students, give me just a minute. I'm just trying to copy it. Yes, it's done. Okay, students. So you can see the question which says that income of Mr. Kamlesh is given, who is an individual resident in India aged 52 years, furnishes you the following information, and he has income earned in country X and country Y. India has not entered into DTL. So we'll go with section 91, unilateral relief. Income from profession carried on in India, 7 lakh 50. Agriculture income in country X. Dividend from a company incorporated in country Y. Royalty income from a literary book from country X. Expenses incurred for earning the royalty 50,000. Business loss in country Y. Rent from a house situated in country Y. Municipal tax paid in respect of the house in the country Y. Not allowed as deduction in country Y. Business loss in country Y not eligible for set-off against the other income as per the law of that country. Rate of tax in country X is 10 and 20% respectively. So then, how will you calculate the income? And here they are saying, assuming that he has opted out of the default tax regime under 115 BAC. So let's start with it, students. How will we calculate this? So first we'll start with the income computation, the normal computation that we are going to do, students. So first is income from house property, the first head of income. Under income from house property, what do you start with? The gross annual value. Here you have a rent which is given of 2,40,000. Right, so I'm assuming rental income is the gross annual value in absence of fair rent or municipal value being given. So you write that assumption that gross annual value is assumed to be rental, which is 2,40,000. Then you get the deduction of the municipal taxes. Now, it doesn't matter, students, in the other country whether this municipal taxes is allowed as deduction or not. Because we are going to compute it as per the law of India. So, municipal taxes need not be paid in India. They can be paid in any country. So, I will allow this deduction of 10,000. Doesn't matter if the country Y does not allow. We are computing as per the Indian law. He is an Indian resident. We will do the computation as per the Indian law. Is this clear? So basically, this is 10,000. Okay. Then what else do you get under the house property, students? Under house property, what else do you get? You get the standard deduction. You get first the net annual value, which is 2,30,000 less standard deduction, which is 30%. This comes to 69,000. So this will give me 1,61,000. Are we clear? So this is the income from house property. Next head of income that we have is the PGBP. Next head of income that we have is the PGBP, right? So for PGBP, what they have said is, we have the business loss in the country Y. And we have the royalty income from a literary book from country X. Now, royalty income is going to be business income only, isn't it? Royalty income is going to be my business income only. And then there is also income from profession carried on in India. So first I'll write is in professional income in India. $7.5 lakhs. Royalties from book. What is the royalty? 6 lakh. Expenses incurred are 50,000. So I will do 5 lakh 50. Some students now will have confusion. Ma'am, you said royalty is taxable on gross basis under 115A. But students, that is for the non-resident. Under 115A, the tax is for the non-resident. If non-resident earns the royalty income in India, that is taxable at 20% on gross basis under 115A if there is no P. For a resident, that is not applicable. 115A is not there for the resident. Yes, Jacob, will the interest paid to the foreign housing loan, foreign bank for the housing loan? That is very important question. Will it be allowed to you as deduction under 24? If under the house property it was given that there is some interest which is paid, will it be allowed as deduction? Answer is yes, it will be allowed as deduction. There is no restriction on that. There is no restriction on that. It just says that interest payable on the capital. Interest payable on the capital. It doesn't say the capital has to be borrowed in India. So it will be allowed, Jacob. Fine. So here royalties 5 lakh 50. So here there is no gross basis which we are going to consider. Fine. Then you have the business loss. So you will set off the business loss over here. Even though the question says that in the other country, why business loss is not eligible for set off. But that is in the other country. In India, intra-head set off is allowed. So we will set off the business loss. In India, we will look as per the Indian law. We are not concerned with the other country, what they are doing. Fine. So this will be 12 lakh 35,000. Okay. Then income from other sources. Now income from other sources. First we have the agricultural income. Now agricultural income in India is exempt under 10. If it is in outside India, this is not exempt. So agricultural income will be taxable. Because this is outside India. Next is dividend, which is 1 lakh 50. That will also be taxable. Fine. Now I will have my gross total income. What is my gross total income? 15 lakh 96,000. Now most of the students will forget over here, there is a chapter 6A deduction student. Ma'am, chapter 6A, which one? 80QQB. Royalty income from literary work. So, if the royalty has been earned in the foreign exchange and it is brought in India within the period of 6 months, then you get the deduction under 80QQB students. Remember chapter 6A deductions chapter. You have forgotten, isn't it? So we had done this 80QQB. If you remember, I'll take you back. 80QQB allowed to resident on the royalties, on the copyright of books which is lower of income from royalties without expenditure or rupees 3 lakh, whichever is lower, where royalties earned outside India, income shall be repatriated within 6 months from the end of the previous year in which it is earned. So we will assume that the income has been repatriated in the India within 6 months. We are assuming that. Okay. So here I will allow 80 QQB, which is 6 lakh, or 3 lakh, whichever is lower. So here 3 lakh is lower. So this will be allowed, isn't it? So this will give me the total income of 12 lakh 96,000. Now your AMT will not be applicable since my total income is less than 20 lakhs, right? AMT is not applicable over here. For AMT to be applicable, total income has to be more than 20 lakhs. Fine. Now calculate the tax for me. First calculate what is the tax liability. We have opted out of 115 BAC. So what is the tax under old tax regime? Calculate the tax along with the cess. If it would have been speculative loss from countrywide, then it would not have been allowed. Yes, Mansha, you're right. The speculative business loss will not be allowed against any business income, only against the speculative business income. You're correct. So we'll follow the laws for India. Mansha, 6 lakh, not 5 lakh 50. 80 QQB, which is there, that is saying the royalty income without the expenditure. So you will not claim the expenditure while calculating the 80 QQB. You will claim in the income. That is fine. But when you are calculating the deduction, that will be the entire income and the 3 lakh rupees, whichever is less. Okay. So calculate the tax for me, students. And if, let's say, for example, you would have gone under 115 BAC, then you would have not got the 80 QQB. That is for sure. Then you would have not got the 80 QQB, isn't it? Yes, sorry, Mansha, this is my mistake. It should be not without expenditure. This should be 2.5 lakh. You're right. 6 lakh or 2.5, whichever is lower. Not 2.5, sorry, 5 point, sorry. This is, I'm writing by mistake. This is 5.5 lakh or the 3 lakh, whichever is lower. You're right. It should be after expenditure. So I think here also you can make a correction in the chapter 6A deduction. This should be income from royalties or rupees 3 lakh, not without expenditure. Okay. What is tax coming to, students? Your tax amount. This is 2,09,352. Mansha, no. Namrata, no. This is not the correct. Jacob, no. Why you are getting the wrong answers? So students, a normal tax provision we have to calculate. Normal tax provision, 12,96,000. So 12,96,000, I am subtracting 10 lakhs straight away from that. 2,96,000 on that. 30%. 88,800 plus 112,500, right? 201,300. So this is the slab rate I have just applied over here. Plus 4% cess, which is coming to 209,352. This is the tax amount, students, 209,352. Now we will calculate the rebate under section 91. Now we'll calculate the rebate under section 91. How will the rebate be calculated? So just write down. So you will write in the examination, students, the conditions for claiming the section 91 rebate. That Mr. Kamlesh is resident of India. The income accrues or arises to him in country X and country Y. And the income is not accruing or arising or deemed to accrue or arise in India. Income is taxed in country X and country Y. And there is no agreement between India and country X and country Y. And therefore, we are claiming the relief under section 91. Now, how it has to be calculated? So here the relief which is there, as I said, is the lower of the tax paid in India on this income and the tax paid in the foreign jurisdiction. So relief under section 91 is lower of tax paid in India tax paid in foreign. First of all, what is the rate of tax in India? You have to calculate that. So you have to calculate the average rate of tax in India. Now what will be my average rate of tax? 209,352. This is the tax liability divided by total income, which is 12,96,000. Into 100. So this is the average rate of tax. Simple. Total tax divided by total income. 16.154%. What is the average rate of tax in country X? It is 10%. So the lower of this is 10%, isn't it? Now, how the relief will be calculated? So, relief is allowed on the doubly taxed income in country X. What were my income in country X? One was the agriculture income. Okay, so this has been taxed in country X. So, agri income, 50K. Then what else was the income in country X? Royalties, which is 6 lakh. But I will not allow the relief on 6 lakh students. Here, for the royalty, I will allow the relief on the doubly taxed income. What is the word uses? Doubly taxed. That income should be taxed in both the countries. What is getting taxed over here is not 6 lakh, but 6 lakh minus 50K minus 3 lakh. So what is my doubly taxed income, students? It is only 2.5 lakh and not entire 6 lakh. Because in India, you are getting the deduction of expenses and 80QQB. So therefore, it has been held in SAR and GAAR case that only the amount which is doubly taxed should be allowed the relief. If you are getting the Chapter 6A deduction, that is not income doubly taxed. The income which is included in your total income, that is the doubly taxed. So you will write here, High Court in SAR and GAAR case held that the relief of double taxation shall be allowed only against the doubly taxed income. That is income included in total. The amount allowed as deduction is not doubly taxed income. Fine, students. So this way I have is 3 lakh as the income on which the relief should be allowed. So rebate under section 91 shall be 3 lakh into 10%, 30,000. That is first. Now what about, this is 1. Average rate of tax in country Y. This is 20%. Now what is my income in country Y? My income in country Y is house property income. Isn't it? It is house property. So again, I will consider over here 1,61,000 and not 2,40,000. So 20% or 16%, whichever is lower. So 16.154%. So I will allow here 16.154% as the tax. So doubly taxed income in country Y. Income from house property 1,61,000. You had dividend of 1.5 lakh. And what else did we have, students? So we had dividend, we had business loss, and we had the rental income. Now business loss, we have allowed the deduction over here. So we'll reduce the doubly taxed income by that amount. So less business loss, which is 65,000. So my doubly taxed income comes to 2,46,000. Now rebate under section 91 shall be 2.46 lakh into 16.154%. This will give me 39,739. So what is the rebate under 91 which is allowed over here? So rebate under section 91 shall be 39,739 plus 30,000. So this gives me 69,739. So my total income here shall be, tax liability shall be 1,39,613. And we will round it off to 1,39,610. You have to round off also the tax liability. Do not forget to do that in examination. You have to round off as well. Namrata, you will not give the rebate under 87 because the income is more than 5 lakhs. Now it is 7.5. When do you give the rebate, students? The first lecture, basic concepts. The rebate is not allowed over here. The rebate under 87A, if you remember, we'll go back to the rebate here for the individuals. Rebate under 87A is allowed up to income of rupees 5 lakh and 7 lakh in the new scheme. So the rebate here is not allowed. Income is more than 5 lakh. Okay, Namrata? Is this particular point clear? All of you, did you understand how do we give the relief under section 90 or 91? Yes, students. Is this fine? Yes or no? Any questions? Any doubt? Yes, students, faster. Yes. Your question can come in the form of students. Your question can come as a theory question as well as a practical question on the relief obligation, students. You can have any of these questions. So if a theory question can come, it can come on what is permanent establishment, what is tax residency certificate. So as I said, in order for a non-resident to claim relief, he has to produce the tax residency certificate. He has to produce the tax residency certificate. Okay. So basically, the tax residency certificate is a residency certificate declaring that such a person is a resident of that country. It is given by the tax authority of the other country. And he has to also give the form 10F. Now, what is form 10F? 10F is basically gives the status of the assessee, whether he's an individual, company, firm, PAN number if allotted to him, what is his nationality, what is his tax identification number, and what is the period for which the residential status is determined for him in the other country and the residence of that person in the other country. So that is given in 10F. So 10F is basically issued where the TRC does not contain all of these details. If the TRC contains all of these details, then the 10F is not required. 10F is required if, let's say, for example, TRC does not mention the period for which TRC is issued, the address of the person, then you have to give the supporting form 10F also. Okay. If assessee opted for 115 BAC, yes, then also the rebate under 91 will be available. Then also rebate under 91 will be available, Jacob. There is no restriction on that. Fine. Yes or no? Any questions? Any doubt? All of you are clear? Okay. Yes or no, students? Faster. Any questions? Any doubt? Shall we proceed further now? Yes, students, faster. I need the answers. Okay. Fine. So now, students, what is remaining is, and the tax of the income country Y will be Mansha 39738. Yes, that is the tax income. That is a relief basically, not the tax Mansha. That's the relief which is given to you under 91. The tax paid in country Y may be something else. Because let's say in country Y, business loss is not allowed. In country Y, the municipal taxes in country X are not allowed. So the actual tax paid may be different. But what they are saying is the rate of tax that we need to take is the rate in the foreign country or the average rate of tax in India, whichever is lower. What if the foreign tax rate is not given in question? Then you will have to calculate. Jacob. Okay, one or two last important points which can come in the examination as the theory question, students. But that, okay, let's discuss that in the end because we also have to get into the GAAR. So whatever the last points that I want to give, we will restrict it at the moment, this particular chapter, because this is something which is almost done. We have to discuss one or two short points, but that we'll discuss once the GAAR topic is over. Fine. Now we'll quickly start with the GAAR topic because that is also very, very important. Again, for the GAAR, the questions can come in the examination, but this can be, students, the theory questions. This can be the theory questions again from the GAAR topic. So we are getting into the general anti-avoidance regulation. We have half an hour left. We have to finish that. And then last 10-15 minutes, I will spend on the few topics that I have not yet covered, which I would want to cover in detail. Okay, so let's get into the first next topic, the GAAR. Now, students, before we get into the GAAR, there is important distinction that you need to remember. There is difference between tax planning, tax avoidance, and the tax evasion. So I've deliberately drawn this line here to give you an idea that tax planning and tax evasion are the two ends, and tax avoidance comes somewhere in between, students. Now, what is that? What is exactly this is going to be? So let's understand this, students, in detail. So students, let's say, for example, that I am trying to reduce my tax liability, and then I'm trying to reduce my tax liability. I'm, let's say, investing in the capital gain account scheme. If I have done the capital gains, I'm investing in residential house. If I've sold a residential house, I'm investing in another residential house to reduce my tax liability. I'm putting in tax saving FDs, equity linked saving schemes. I'm putting in LIC. I'm putting in medical premium to reduce my tax liability. So that is tax planning, which is arranging the tax affairs intelligently by claiming the provisions of the tax law which are available to me. Or let's say, for example, I'm deciding whether I should opt for LLP or I should go for company. And then I'm comparing the tax rate. In the company, I have a 25% tax rate available. In LLP, I have 30% tax. Or I should continue with proprietorship. I should go for the optional regime or I should go for the regular tax regime. So all of these are the tax planning strategies. I should issue the share capital or I should issue the loan, because loan will have deduction, share capital will have the dividend. I should take the assets on lease or I should take the assets by purchasing them. So depreciation versus lease rental. So tax planning is something availing the exemptions or the deductions within the framework of law. Within the framework of law, if I'm doing something, students, then that is something which is permissible to me. I don't have a problem in that. Isn't it? So this is minimization of the tax liability by remaining compliant with law. So I can write over here. by remaining compliant with the law. So this is entirely legal and permissible. This is entirely legal. Then comes tax evasion, which is the other spectrum of the law, students, which is something which is the other spectrum of law itself, which is willfully avoiding the taxes, by doing fraud. Remember 208, sorry, not 208. Remember the penalty of 200% of the misreporting, misrepresentation or suppression of facts, failure to record the investment in the books of account, claim of expenditure not substantiated, recording of the false entries, failure to report international transaction, failure to record any receipt in the books of accounts. So, willfully evading the taxes can result in the misrepresentation or suppression of the facts, failure to record the investments in the books of accounts, claim of expenditure which is not substantiated by evidence. This can all result in the misreporting of income and penalty under 270A. So, you can just write it over here. Misrepresentation of facts, failure to record investment in the books of accounts, false entries in the books of accounts, claim of expenditure not substantiated by evidence, or failure to report any international transaction. Failure to record receipts in the books of account. All of this result in the penalty of 200% on misreporting of income under section 270E. Plus there was, students, the prosecution. Plus there can be the prosecution. This is basically something which is illegal, students. This is completely illegal. So tax planning is legal. Tax evasion is something which is illegal, students. Then what is the tax avoidance, students? So tax avoidance, student, is the tax avoidance is basically, students, something which is falling in between, which is legal but immoral, wherein you are exploiting the opportunities under the law to reduce your tax liability, that you are following the letter of the law but not the spirit of the law. For example, I told you that the companies were incorporating the SPVs or intermediate company by doing treaty shopping in Mauritius. It is as per the letter of the law. But is it as per the spirit of the law? You're not coming directly through US, but you are forming an SPV in between. You are avoiding the taxes. That is something which is not permissible. So what is tax avoidance? Utilizing the gaps in the law or following the letter of law but not spirit of law. So for this we have the SAR, Special Anti-Abuse Regulations, and the GAAR. So tax evasion, since it is illegal, GAAR will not target that because it is any which way is illegal. Tax planning is legal. So again, GAAR will be attracted on that. GAAR and SAR will be attracted on these schemes of tax avoidance, which are the artificial schemes taking the benefit of law. These are the artificial schemes which are taking the benefit of law. So in the Duke of Westminster case, this is an English case. It was held that every man is entitled to order his affairs, to arrange his affairs in the way they want it. Every person is entitled to arrange their affairs in the way they want it to reduce their tax liability. This was the decision of Duke of Westminster. So every person is entitled to arrange the affairs in the way to reduce the tax liability. So this was given way back, and this in fact allowed the tax avoidance. So in this case, it was held that yes, tax avoidance is permissible if you're doing that. There's no problem because you're arranging the affairs, and if the law is not restricting you, then there is no problem. But slowly and steadily, we moved away from the principle which was enunciated in Duke of Westminster case. So in Ramsey case, in Burma Shell Company case, it was held that no, we need to look the substance over form. We need to look the substance over form. So in Ramsey case, it was held that one needs to look into substance over form. So this was the departure from the Westminster principle. This was the departure from the Westminster principle. Even in Burma Company, same thing was held, where the tax avoidance is coming through series of transactions with the only aim of avoiding tax. Then the courts have to ignore the transactions as if they never took place. If the transactions are designed to avoid tax, then courts need to ignore the transactions and determine tax as if it never took place. So this was outside India. This is a scenario which was developing outside India. In India, the Duke of Westminster was clearly followed for a very long term of time. But then came a point where in India, even the Duke of Westminster was departed in the McDowell case. In India, Duke of Westminster was followed for a very long period of time. But in the McDowell case, the Duke of Westminster principle was departed. So what they held in the McDowell case, they said that every person is entitled to arrange their affairs in the way they want it, but it is not desirable. Or what they said is that the tax planning may be legitimate. Tax planning may be legitimate provided it is within the framework of the law. Provided it is within the framework of law. And colorable devices cannot be part of the tax planning. So any artificial scheme cannot be part of tax planning. Tax planning you can do, there is no problem. But it is wrong to encourage the belief that by adopting some dubious methods, you can get into the tax avoidance. That is something which is not permissible. That is not at all permissible. Are we clear? Any questions, any doubt till now? So one needs to adopt the substance over form approach. The transactions have to be ignored and one needs to look into the exact substance of the transaction as to if these transactions were motivated by tax, ignore this and determine the tax as if these transactions had never took place. So till now, until and unless the GAAR was introduced, till now we were only relying on these judicial decisions and these principles which were coming out of these judicial decisions, substance over form, to disregard the transactions. There was no statutory provision in the Act to provide or to override these transactions. So that is why the GAAR provision has now been introduced. Yes, Mansha, you are clear, right? That we can do a tax planning in respect of the house property we choose as the self-occupied property. That is tax planning. That is tax planning, you're right. That is something which is permissible. But something which is not permissible is the tax avoidance. So now we have the GAAR in place, which is chapter 10A. So the GAAR is basically, we have, as I said, the GAAR and the SARs. SARs meaning there are specific anti-avoidance regulations which are targeting the specific anti-abuse, which is like section 56 to 10, section 56 to 7B, right? Gifts and the issue of shares at lesser than fair market value, clubbing, deemed dividend, right? So there are so many other SARs which are targeting the specific regulations, transfer pricing students, POEM, indirect transfer, section 79. These are targeting the specific tax avoidance scheme. But what is not covered by them will be covered under GAAR. Will now be covered under GAAR. So GAAR is basically the codification of the substance over form principle. One needs to look into the substance over the form. Are we clear? Now, when will the GAAR be applicable? When is the GAAR getting applicable? So, students, the GAAR become applicable. The GAAR gets applicable when there is the main purpose is to avoid the taxes. When the main purpose is to avoid the taxes. So the GAAR, where the arrangement has been entered into as an impermissible avoidance arrangement. Now you will say, ma'am, we are not able to understand. I'll explain how the GAAR has to be looked into. So section 95 provides for the applicability of the GAAR. So you can just write it over here. Codified substance over form. Yes, here you can use many other examples. Dividend stripping, bonus stripping under section 94. What is dividend stripping and bonus stripping? Dividend stripping and bonus stripping is basically, let's say for example, students, if I buy the securities within 3 months prior to the record date, let's say for example, I'm buying the units, right? And within 3 months, we have a record date for the dividend, right? Dividend declared. So I know dividend is going to be declared 3 months prior, I'll buy the securities. And then within the 9 months from here, I will sell the securities. So basically, here in this particular case, earlier dividend used to be exempt. So then these provisions used to get triggered, but now it is no more relevant. So then the loss which is arising on these units will get set off, will not be allowed to the extent of dividend income. But now these are not prevalent. Since somebody asked this question, I just explained it. So here this is something which is not relevant as of now because the dividend was earlier exempt. Now this is no more exempt. So this provision is currently irrelevant. This used to be the case when the dividend was exempt. Okay, students? Yes or no? Yes, this could be relevant, students, in the context of where the dividend is received from the SPV, from the business trust, where the SPV has opted for, not opted for 115BAA. So in that case, this can be still relevant. So this dividend stripping or bonus stripping is relevant where SPV has not opted for 115BAC and dividend is distributed by business trust to the unit holders, which shall be exempt. So then in that case, what happens is the loss, the capital loss which occurs on the sale of the units, this shall be reduced by dividend. This is reduced by the dividend. Okay, so dividend, if it is exempt, then in that particular case, only this provision is relevant. So this is the SAR, a specific anti-avoidance regulation. Okay. Now coming back to the GAAR topic. So as I said, section 95 deals with the GAAR. It says, notwithstanding. It's a non-obstant clause. It says, notwithstanding anything contained in any other provisions of the Act, if the arrangement is entered into by assessee, if an arrangement is entered into by assessee, if an arrangement is entered into by the assessee, which is an impermissible avoidance arrangement, students. So if this is an impermissible avoidance arrangement, if it is an impermissible avoidance arrangement, then in that particular case, the GAAR will get attracted. Now, what is an impermissible avoidance arrangement? Where the main purpose, so there are two tests into it to determine what is an impermissible avoidance arrangement. So the first test or the primary test is if the main purpose is to obtain the tax benefit. And then there is secondary test. So there are two tests, primary test and the secondary test. The primary test is if the main purpose is to obtain the tax benefit. Secondary test is both tests needs to be satisfied. This is and. Secondary test is called tainted element test. Tainted element test. What do we understand by tainted element test? Section 96 is defining the impermissible avoidance arrangement. This is section 96. So what are the four conditions? The four things are, I'll put it over here. The tainted element test. Creates rights or obligations. Creates rights or obligations which are not ordinarily created between the persons dealing at the arm's length price. Meaning, so let's say for example, I have relation with the another person. And during that course, I would have not entered into such kind of transactions with unrelated person. See, then you will say, ma'am, transfer pricing is already there in picture. So then do we apply the transfer pricing or do we apply the GAAR? What do we do then in that particular situation? Do we apply the transfer pricing or do we apply the GAAR, students? So students, in this particular situation, if the SAR is applicable, then the GAAR will not apply. So CBDT has clarified that if the SAR is applicable, GAAR does not apply. So where SAR is applicable, the GAAR will not be applicable, students. It is only when the SAR is not able to cater to the situation, then only the GAAR will become applicable, students. So CBDT has given the clarification that SAR and GAAR can coexist. They can coexist. But where SAR is applicable, GAAR will not apply. But where SAR cannot apply, GAAR shall apply. So what is the meaning of that? See students, in the transfer pricing, what you just check is the arm's length pricing. You do not check if the conditions are also at the arm's length. Are you getting this particular point, students? So let's say, for example, there is an arrangement which has been entered into, wherein what I'm trying to do is, I'm trying to shift the manufacturing, let's say, from a non-SEZ unit to an SEZ area. Let's say I'm showing the production as of the SEZ unit Let us presume that there's an Indian company. I do not show that as a production of a non-SEZ unit, and I show it as a production of SEZ unit. And I do only some insignificant activity in SEZ. So in that case, the GAAR can apply. So SAR will check what? Only the pricing. If the goods are transferred from non-SEZ to SEZ, the specified domestic transactions will be kicked in. So where the SAR is not able to take care, then I will apply the GAAR. Then I will apply the GAAR. Are we getting that? So if the conditions are not at arm's length, that is not taken care by the SAR, by the transfer pricing, then the GAAR will be applicable. Then the GAAR can apply. Obviously, there are also provisions under 10AA with regard to this. Under ATIA, there are provisions with regard to this. So then if the provisions are able to cater that, then we will not apply the GAAR. Then we will not apply the GAAR. Are we clear? If you are shifting the business from one entity to another and you are reconstructing the basically unit in SEZ, you are not starting a new business in SEZ, you are just reconstructing the old business. So let's say, for example, what you're trying to do is you are going to transfer the goods from non-SEZ to SEZ. By not actually transferring it, by not taking the new orders in non-SEZ, and you are trying to take orders in SEZ. So it's just a reconstruction of the new business. So that is again taken care by 10AA. Then in that particular case, the GAAR will not apply. Are we clear? Okay. So that is the first scenario. What is the second situation over here? Results directly or indirectly in the abuse or misuse of the provisions of the Act. Now this is very, very clear. If it results in the directly or indirectly abuse of the provisions of the law, then in that particular case, the GAAR will get kicked in. Okay. So let's say, for example, where I'm misusing the provisions. Let's say, for example, I incorporate the company in Mauritius. So instead of coming through directly, I'm incorporating the company in Mauritius. Then in that particular case, the GAAR can be invoked. Because there is no commercial substance of incorporating the entity in Mauritius. So that is the place where GAAR will take. Third is lacks commercial substance or is entered into or carried out by manner which are not ordinarily employed for the bona fide purposes. So if I have not entered into any transaction for bona fide purpose, then in that particular case, the GAAR can kick in. It is not having any commercial substance or deemed to have commercial substance. Now, what do I understand by deemed to have the commercial substance, students? So, deemed to lack commercial substance is again defined in section 97. How is it defined? Deemed to have commercial, deemed to lack the commercial substance. So basically, it is defined in this way. Okay. So how is it defined? It says substance is inconsistent with the form. If the substance is inconsistent with the form, if my substance is not in accordance with form, my transaction says something else, but if I see into that country, I do not have any substance. There are no employees, nothing. Let's say, for example, if the loan is given by one company to another company, wherein the company which is giving the loan has no ability to give that loan. It is just taking the income from somewhere and passing on the income to another company just to claim the deduction. So that is something which is substance different from form, where I do not have ability to give the loan. How will I give the loan? Let's say, for example, I have income from company A. I have received that income. I'm a company B, and I'm paying that income as interest expense to company C. And company C has given me the loan wherein it does not have any funds to give me that loan. It may have just taken the share capital from me and it is now giving back as loan to me. That is something substance different from form. Secondly, it says round tripping. What is round tripping? Let's say, for example, there is Mr. A. If he directly invest in the, let's say, shares of Indian company, the capital gain will be taxed in India. So what he will do is, he will incorporate the company in Mauritius, and this company will invest in the shares of Indian company. So this is round tripping. Funds are going outside India and coming back to India. This is a classic case of round tripping. This is not permissible. This is something which is not permissible. Next is transaction has accommodating parties. There is some in-between SPV formed just to avoid the tax. Elements that have effect of offsetting or cancelling each other. I have received royalty income. I am paying the interest expense. It has cancelled each other. Transaction which is conducted through one or more person and disguises the value, location, source or ownership. I am forming a company in some jurisdiction and conducting the business in some other jurisdiction. That company is just a sham company. Involves the location of an asset or the place of resident is without any commercial purpose. So I've incorporated the subsidiary in Mauritius. I've changed my residency to being a UAE resident without any substance. It does not have a significant effect on the business risk or the cash flows. So basically, there are no commercial reasons why this company is incorporated. Are we getting that? So all of this is done just to avoid the tax benefit. And in that particular case, this will be considered as the impermissible avoidance arrangement. Now, what if it is considered as the impermissible avoidance arrangement? Then what are the consequences? What shall be the consequences of the GAAR? So section 98 of the Act provides the consequences once the GAAR becomes applicable. What are the consequences, students? So the consequences in this case will be disregarding, combining or recharacterizing any step in the transaction. So basically disregarding the transaction. We will not disregard as if this transaction has happened. Treating the arrangement as if it has not entered into. Disregarding the accommodating party. Reallocation of the income. Treating the place of residence or situs of asset in other country. Looking through the arrangement, which is basically nothing but the substance over form approach. Are we clear? Now, when this GAAR will be applicable. So there are certain limits which are there. So the limit is 3 crores rupees. If the tax benefit is more than 3 crores, only then the GAAR will apply. So tax benefit should be more than rupees 3 crores. If it is less than 3 crores, then it will not apply. And there are certain exemptions. What are the exemptions? To the foreign portfolio investor coming through treaty country, on them the GAAR will not apply, and who has not taken the treaty benefit. Secondly, the transactions prior to 1st April 2017, before the GAAR was applicable. Are we clear? Also, if you remember, students, in the assessment class, we had seen that the GAAR will be triggered only after the approving panel approves it. So it is through the approving panel that the GAAR can be triggered, students. Isn't it? It is only through the approving panel. If you remember in the assessment procedure 144 BA section, we had seen that. See, AO to make reference to PCIT to declare the arrangement as IA and determine the consequence. PCIT or CIT will issue the notice to assessee, and then PCIT or CIT, if it is not satisfied, it will make a reference to the approving panel. It will make a reference to the approving panel. And this approving panel will inquire, call for documents, and then issue the directions. And based on these directions, the AO will complete the assessment. This is completely binding on assessee, PCIT or CIT, and no appeal can be filed against these directions. And against this particular order also, students, against this order, no appeal before CITA. Directly you can go to ITAT. No appeal before the CITA is also possible, directly to the ITAT against the AO order, against the assessment order. Are we clear? Yes, students, is this clear? Is the net tax benefit exceeds 3 crore or the gross tax benefit? It's the gross tax benefit, Jacob, not the net tax benefit. Fine. Now, there are certain small points which I would like to discuss. As I said, some small topics that I want to discuss and the international tax, double tax relief. So we'll quickly go back to the international tax class. What are the points that I wanted to cover with you? Students, under section 90, if you go back to section 90, there's one small point which is saying that for the removal of doubts, it is hereby clarified that the charge of tax in respect of a foreign company, explanation 1, at a rate higher than the rate at which domestic company is chargeable shall not be regarded as less favorable charge. Now, what is this, students? Let me explain you. So, foreign companies are taxed at 40%. Indian companies are taxed between 15 to 30%. Isn't it? So under the tax treaty, students, there is a provision of non-discrimination. There is a provision of non-discrimination clause. Now this particular article says that the foreign company cannot be discriminated as compared to the Indian company. And both the countries agree for that they will not frame any tax policy which is discriminating the foreign companies as against the Indian companies. So basically the act is saying that if we are levying 40% rate, that is not discrimination. So the 40% rate to foreign company is not discriminatory and is not violating the non-discrimination article. Is not violating the non-discrimination article. This is one point I wanted to talk about. Secondly, students, what happens, because there are these questions in your module, so that's why I wanted to discuss these points. See, it is possible that a person may be regarded as a resident of two countries at a given point of time. Let's say in India, he has stayed for 180 days, so he is an Indian resident. Let's say in the other country, he has stayed. Let's say in the other country, he is a citizen of the other country. And in the other country, the residential status is determined on the basis of citizenship. For example, in US. In US, it is if you are a green card holder, you are a resident of US. So let's say, for example, I am resident of India since I have stayed for greater than 182 days. And I am resident of USA as I am citizen of USA. So what do we do in this case? So the DTAA gives a tiebreaker test. The DTAA gives the tiebreaker test. Now, what is a tiebreaker test? I mean, this is the test. In the match also, if you both the parties win, right? So we do a tiebreaker. Similarly here, which country will be the ultimate resident country? Is determined using this test. Because otherwise both the countries will tax my worldwide income. So if I'm a dual resident, then both countries will tax my worldwide income. So I've resolved using the tiebreaker test. What does the tiebreaker test do? This is given in Article 4 of DTAA. It gives, you look into where is my permanent home? Where do I have the permanent home? Whether it is in India, whether it is outside India. Permanent home can be a rented home also, students. Where I'm living for majority of my time. Where is my permanent home? Second, you look into the center of economic and personal interest. Which country I am doing my business, which country I am doing the job, where my family is staying. To check that center of economic and personal interest. Habitual abode. Where I am finally going to get settled. Where I am finally going to get settled. So that is the place of my habitual abode. Where I am likely to return to. And finally, nationality. Where I am national of. So based on these tests, you have to go one by one. It is not that you can check any of these tests in any order. You have to check in this particular order only, students. You cannot do interchange in the test. Is this clear? So basically, I need to check these particular conditions where I am having the permanent home, where my personal and economic relations are closer, where I have habitual abode, where I have national law. And based on that, you determine which is the ultimate resident country. Whichever, let's say, for example, India is the ultimate resident country, then US cannot tax my worldwide income. Only India will be able to do that. Okay? Yes or no? Yes, students, any doubt, any questions till now? And last 2 points which are to be discussed. One is section 9. Under section 9.1, there is one more source rule. There is one more source rule under section 9, which is newly introduced. Not in this budget, of course, but which is introduced in section 9, which is I think which we had written also earlier. Students, you will have to bear with me. There is going to be some extension of the time because this is going to be the last class. Yes. Section 918, which is the provision in relation to the gift students. So any income arising outside India, being the sum of money, which is paid by a person resident in India, either to a non-resident or to a RNOR, will be considered as the income deemed to accrue or arise in India. So just write down over here itself. So this is gift of money by resident to a non-resident or the RNOR. This is going to be deemed to accrue or arise in India. This is going to be deemed to accrue or arise in India. Are we clear? Okay. Then there are two TDS obligations that I wanted to discuss. One is section 195. Students, have you done 195 or am I required to discuss over here? I'll just quickly give a recap of 195. So section 195 is the TDS obligation in the case of the non-resident students. Section 195 is the TDS obligation in the case of the non-resident. So just write down over here. Have you done 195 so I don't need to spend time? Can you just answer in the chat box? Is TDS under 195 already been covered for you? So TDS under section 195. So 195 says that students that the TDS on the payment made to a non-resident other than the salaries which are there. That is because I told you that is covered under which section? Under 192. So salaries is not going to be covered over here. So this is other than the salary, other than 194 LB, LC, whatever we have covered so far. So other than that, any other sum. So this is on the, who is going to be the payer? It can be resident as well as the non-resident. Payer can be resident or a non-resident because it says any person. Payee has to be a non-resident. Payee has to be a non-resident, including the foreign company having the poem in India. So a foreign company having the poem in India is regarded as a resident. But students, since the CBDT circular clearly says that the notification already says that the provisions of 195 will apply. Remember, we did that in poem. So provisions of 195 will be applicable in case of the foreign company having the poem in India. Are we clear? So therefore, payee can be only a non-resident or a foreign company having the poem in India. Secondly, what is the applicability on? Any sum which is chargeable to tax in India. Any sum which is chargeable to tax in India other than, of course, the salaries. Then in that case, you will have the TDS under 195. Rate of TDS is rates in force, which means rate under Act or DTAA, whichever is beneficial. Here, the payer as well as the payee can apply to the AO to get a lower deduction certificate or to determine the sum which is chargeable to tax. So, payer can make application to AO to determine sum chargeable to tax. And similarly, payee can also make an application to the AO to determine the sum chargeable to tax. So payer or the payee, both can make. Both can make the application to determine the sum chargeable to tax. Are we clear? Secondly, here the refund can also be obtained if there is tax deductible which is deducted at a higher rate and there was no tax which was required to be deducted, then the refund application also can be filed by the payer. So basically, payer can file for TDS refund if tax was not required to be deducted. If the tax was not required to be deducted, if the contract is cancelled or the remittance is not made, or let's say, for example, the exemption is there by any law, or that there has been twice deduction. So basically, or if the tax has been deducted at higher rate, in all these cases, the amount can be refunded to the person who has deducted it, provided the payee has not claimed the refund in the income tax return. Are we clear? So basically, in that case, the refund can be made to them. Yes? Any doubt, any questions till now? Then there is one more provision which is basically, okay, your form 15 CA and CB is also required. 15 CA and CB is the remittance certificate and CA certificate. To declare the remittance. This is compulsorily required. Okay. Then there is one more provision, students, which is 206AA, which is tax payable at the higher rate if the PAN is not obtained. I think this you would have done it already. The time limit is there, students. Yes, Jacob, the time limit is there. The time limit exists, which is within 30 days. For the refund application, you are asking, isn't it? You are asking for the refund application, right? So application for the refund is within 30 days from the payment of tax. You are right. So basically, students, there is 206AA. 206AA will not be applicable, students, in a situation where the PAN is not obtained. But if the non-resident gives the tax residency certificate, Form 10F, and the tax identification number. So you can just write down 206AA not applicable even if non-resident does not furnish PAN but furnishes the tax identification number, tax residency certificate, name, contact, and the address. So then in that particular case, the 206AA will not apply. Finally, one last provision, which is in the case of Just write down one last provision. That's it. We are just going to end, students. Please bear with me. Which is 194E and 115BA. So just write down. Taxation of non-resident sports person. Taxation of non-resident sports person. Now, what is this particular or sports association? This is a separate provision altogether. This is under 115 BBA. So, where a sportsman is there, where a sportsman is there who is not a citizen of India or a non-resident. So, non-resident sportsman who is not an Indian citizen. One. Secondly, there is a non-resident sports association. And the third one is a non-resident entertainer who is again not an Indian citizen. So a sportsman receiving the income from a participation in any game, from the games, other than the crossword puzzles, race horses, or betting or gambling. Right? Other than these games. Income from games, income from advertisement, or contribution to of any articles in any game or sports in India in newspapers. So contribution of any articles to journals. If there is non-resident sports association in respect of the amount which is payable in relation to any game. And if there's a non-resident entertainer, if he is receiving the income from performance in India, then their income is taxable on the gross basis at the rate of 20%. So this is tax at the rate of 20% under 115 BBA on the gross basis. Further, here the TDS will apply. TDS will apply under 194E. Here again they have exemption, no ITR to be filed if only income is 115 BBA income and the TDS has been deducted. And TDS deducted under section 194E. So if the TDS is deducted under 194E, then in that particular case, the income tax return is not required to be furnished. Of course, this is 20% plus surcharge plus cess. Are we clear? Now, the question here arises as to whether the non-resident referees and the umpires are sportsperson. So, basically, this has been answered by the Calcutta High Court in INCOM. So, umpires and match referees, they cannot be considered as non-resident sportsperson. So, umpires and match referees are not the sportsperson. So, you can write down umpires and match referees are not covered. So 115 BAA will not apply to them. 195 will be applicable on them. Okay. Yes or no? Any questions, any doubt till now, student? Yes or no? Further, there is one more recent decision in the context of PILCOM, which is again part of your module. So this decision is basically in relation to the income accruing or arising in India. So we'll just end with this decision, students. So ICC, which is having the headquarters in London, International Cricket Council, this is basically regulating the cricket all across the world. So there was one joint committee formed between India, Pakistan and Sri Lanka to conduct the World Cup tournament. And the bank account of that committee was opened up in London to be operated again by India, Pakistan and Sri Lanka. Now the BCCI, which is the Board of Control for Cricket in India, this particular INCOM had that had its own committee, which was known as INCOM. Now, certain amounts were transferred by this PILCOM, which is the Pakistan and Indian committee which was formed, to the bank account of BCCI as the guarantee money to be paid to the Cricket Association. Now, the question which was there is whether this amount will be taxable in India. So the question was answered by the Supreme Court that these non-resident sports association had played the matches in different countries. And this was connected with the events which various cricket teams were scheduled to play and participate in the event. So the source of income was the playing of the matches in India. So this is basically the source of income was in relation to the cricket match to be played in India. And therefore, this amount shall be deemed to accrue or arise in India. Are we getting this particular point? Yes or no? So this was in regard to where the source of income is. Fine. Time limit for determining the applications of sum chargeable to tax. There is no time limit. Before making the remittance, you will have to make a request to EU, Jacob. So with this, I end up, sorry for delaying this lecture, but since this was last lecture, students, I had to delay it and had to finish it off everything. So I have covered everything comprehensively. I say all the best to you. If you have any questions, please drop to the institute and they would forward it to us. So anything you want to ask, we have 2 minutes time, you can ask, and then I'll just close the lecture. Black money law, I have covered, Jacob, already in detail. You can look into the past classes with respect to the penalties topic. There I've covered the black money law. Now, only topic which is remaining for you is the audit, tax audit, which will get covered in the subsequent lecture. Namrata, the last decision of PILCOM, you can read it from the module also. It's just a simple thing that the amount which was paid by the PILCOM to the Indian BCCI, which was in relation to the sports game which was to be played in India. So that amount shall get taxable in India. That's a simple decision that was particularly covered. Is that clear? I hope it clarifies. Yes, any other doubt, any other question? So I've covered all the topics. Only one topic is left, which is the tax audit, which will get covered by another faculty in the next class. Namrata, for exam, there are no such tips, but you have to just keep reading the module and practicing. Practice your presentation. Presentation is very, very pivotal, Namrata. So do not just read the module and understand that, okay, this is fine. Do practice the past exam question and practice with the great effort as you would, do it for the examination. Okay. Okay. Okay, so thank you so much, students. All the best for your examination. We can close the class. Jacob, is there any amendment in DTAA chapter and GAAR? No, there is no amendment. How many revision needed? There are maybe 2-3 revisions needed, Namrata, for this. Okay, we can close the session.